I heard you just had a great sandwich, though.
I did have a great sandwich.
Yeah.
Welcome back.
Yeah.
Welcome back, everyone. This is the Business Prospective. Two pros, professionals, two bros, helping your business grow.
One conversation at a time.
One conversation at a time. Today, we're discussing profitability and cash flow and how they impact your business. I invited Hunter from Strata Cloud, a professional CFO that helps companies with their finances. And we're going to be asking them some questions. And we're going to be discussing how that affects their business. So Hunter,
Let's do it.
profitability, define that for us.
Okay. Profitability would be, so you can think of this like your profit and loss statement or your income statement. It is going to be the revenue that you've earned and minus the expenses that you've incurred would be your profitability. Now, revenue earned doesn't necessarily mean that you've received that revenue.
Okay.
Expenses incurred doesn't necessarily mean you've paid that money out your bank account.
Gotcha.
So, for example, revenue earned could be, hey, you did the work is done, or you delivered the product's there, you sent the invoice and it's not paid yet. Or maybe in some industries, maybe they've paid you a large retainer up front, the client, but you have not actually earned that money yet. And so what you're trying to reflect is your actual business model of what have I actually earned related to the expenses I've actually incurred. So on the expense side, maybe you've paid a large amount out for like an annual software cost or something like that. That's money out, but that's not really the expense that you've incurred. That expense is incurred over the next 12 months or however long the period is. On the flip side, maybe there's vendors that you haven't paid yet, but they have done the work or delivered the product, and so the expenses incurred. So we're looking at earned minus incurred equals the profitability.
Yeah. And like you said, that can be tricky with people, especially when they have terms that are like 30-day, 60-day scenarios when they're paying for things in advance, like insurance.
Right.
And so then your profitability may look, or it may be deceiving in a moment if you're not tracking that correctly. Correct?
Yeah, if you're not tracking it on what we finance people call accrual basis, if you're not doing your financials on an accrual basis, then you might not really be looking at what your profitability is any given month.
Okay.
1 month your expenses could look super high when the reality is you just had 3 payroll periods that month, or one big software or insurance costs go out the door.
Yeah.
Even though that's not real reflective of what the cost incurred in those actual 30 to 31 days that you're looking at.
Yeah, and we're going to dive in a little bit more in the nuanced area, because I think the viewers know like the difference between profitability and cash flow to a degree. They understand the concept. And you and I have talked to business owners where it's like, you know this, but you're not, the way your business is behaving doesn't seem like you really fully understand this. And you're not bridging gaps for cash flow, or you're operating and scaling in the wrong direction and you don't realize it because the cash flow is good. So we talked about profitability. Now let's look into what is cash flow.
Yeah, cash flow is just the money that went out and the money that went in. What was the net change in your bank accounts?
Super simple, super easy.
Now, this could be from anything, though. This could be from a loan that you got, or investor money coming in, or it doesn't necessarily just have to be when we say cash flow, we're not just necessarily talking about what's coming in from customers and out to vendors. It could be money going out to pay a loan, distribution for yourself, distribution for your investors, you name it. Just anything coming in, anything going out.
Yeah. And I can see where that would get, again, may look simple on the surface, but it can get nuanced, and understanding how cash flow affects your business and treating profitability as something else that affects your business and making sure you're tracking both is super helpful.
Yeah.
So even recently, I was talking to a customer who was experiencing a lot of chargebacks for services rendered. And that becomes tricky because, as finance person, like, okay, we incurred we got the cash, then we did the service. So it's like, that looks healthy, but now we have a chargeback.
Like a discount or something?
No, like they decided they wanted a refund.
Oh, wow.
Yeah.
Sure.
And some of it was fraud. And so they're working through that.
Yeah.
But it's like, well, if you were to just look at that one sale for the month of May, you would say healthy, good. But now that one individual sale, the next month is not good. Sure. Because you had to pay back all the money, plus you still incurred the cost of doing business for that. Yeah. And so walk us through like maybe a scenario where you have healthy cash flow, right? But profitability is not there.
Yeah, I would say that scenario is less common amongst customers. But, maybe some examples of what could happen would be, I've had clients before who maybe they have a line of credit or some sort of loan or investor money come in. And so their cash flow, their bank account looks great. Mm-hmm. They're like, oh, that's great. I'm flush with cash. Mm-hmm. But the reality is it's from an outside source that either they're going to have to pay back or down the line or whatever. Mm-hmm. But the reality is they're unprofitable. That's why they had to take the money. Yeah. Right. So this happened a lot during COVID, where like people were getting PPP money in that had no payments on them, eventually got forgiven. Yeah. But there was almost like this illusion for some businesses that we're doing great. We got all of this money. Yeah. Even though because of the challenges of COVID, they were becoming more unprofitable.
It was artificial.
Yes, it was artificial. Yeah. Other examples are there could be months where you don't have profitability, but you do have cash flow because maybe you collected on invoices that were from a prior month. Mm-hmm. So maybe there's just a lot of collections. The timing of prepayments happened in a different month if you were prepaying softwares or insurances. There can be those small, just operational things that happen too. But I would say it's less frequent that cash flow is going to be good when profitability is bad.
Yeah, the one model that I saw that I ran into was similar with that was there was like an onboarding fee, right? It's for a service company, and then they had their, so that was good. And then they had their retainer or their fee that they had every month for that customer. However, the cost of the service sold, or cost to maintain that customer, was high and already had low margins based on the service that they were providing. If you do direct, like, well, we're paying for this specific thing for this type of, but then they also their operations were also getting more expensive as they grew.
Sure.
And so that required more, like a bigger office and things like that. And so they kept the model the same. And so it looked like every time we get a new client, we're doing really good.
Right.
But when you would forecast it out or project it out, you realize that there was a deficit.
Yeah.
In terms of profitability, but it was hidden because they were growing so fast that you couldn't see it. You couldn't see the deficit because it just looked like every month they were just making more money.
Yeah.
So they were like, well, let's just keep doing this.
Right.
And it wasn't until like, year and a half later, they're like, why does it feel like we have no money, even though we're making more money than we were ever before? Yeah. And that was a situation that I ran into. Yeah. And so now, is there a situation where someone is really profitable but has cash flow issues?
Oh yeah, I would say that can happen quite a bit. Where most of the time, what is the issue there is collections. So maybe they're doing a bunch of work, sending out a bunch of invoices, having trouble collecting on those invoices.
Yeah.
And so profitability, when you look at their P&L, it's like, oh, you're doing great. You're earning a great gross margin. You're bringing some stuff to the bottom line. All of that looks great. But the reality is maybe there's several 100,000 of invoices that they haven't collected on.
Yeah.
So that's a very common scenario. In fact, that I would say most of the time when I'm talking to somebody, the question is, I see that I'm profitable. I don't understand why there's not money in my bank account, though.
Yeah.
Another one that we've had, month over month, they look very profitable, right? They actually collect very well, but they pay so much in the principal of their equipment loans that they basically just take that profit and put it towards the principal balance of the loans.
Wow. Yeah.
And so there's not much left over.
Yeah.
And so their question is frequently, again, I see I'm profitable, but there's like no money in the bank.
Yeah.
And I feel like I'm living paycheck to paycheck.
Yeah.
Why is that?
Yeah. I've ran into that exact same scenario. This was commercial construction, which requires one. It's that was like twofold. It was like collecting payments was really hard because it's like nobody cares. GCs don't get paid. They don't get paid. Nobody cares. And then the second one was the investment in the equipment was so high that the monthly the monthly payments to that, it made it difficult for them to keep their prices at a place where they can recoup the necessary amount of money they need to pay on a monthly basis for equipment and be competitive in their bids to do the work.
Right.
And so like on paper, it's like, okay, this project cost this much and you made this much. You should be doing 100 projects.
Right.
But they can't afford it. Like, why can't we afford to do it? Why is it that we never have money in the bank? And that's kind of what sparked this conversation is like I ran into a lot of businesses like that where the owners will tell me, it just seems like QuickBooks is telling me we're profitable, but I don't have any money in my bank.
Yeah.
Like if I made 20,000 extra last month, why don't I have an extra 20,000 this month to play with? And that's what we talked about. Yeah.
Yeah, we have this saying in accounting finance world that goes, revenue is vanity, profit is sanity, and cash is reality. So if you're just chasing revenue, that's really just a vanity metric because it doesn't mean much if you don't have good margin on that revenue or if you're not breaking even on your overhead. The amount of revenue if you just came and told me your revenue, it doesn't really mean much to me.
Yeah, how much did you cost?
Maybe it sounds impressive, if you said like something crazy, but it doesn't mean much. Profit is sanity because I'm profitable on that revenue.
Yeah.
Right? Like that's good. That's a good thing.
Yeah.
Right. But the reality is what's in your bank account.
Yeah.
Are you turning that profit into actual dollars into your bank account that you can either take out personally or invest or really direct it towards a way that's going to lead towards what you hope to see?
Yeah. Yeah, because I think what you're saying is that you can have great revenue. You can be profitable on paper.
Yeah.
But if that money doesn't find a way to make it back into either the business account or the owner's account, it really doesn't mean anything.
Yeah, I mean, eventually that profit should make it back. If you've actually done the work, people are actually going to pay, or whatever the case is, it should make it back. But you can be profitable and still be forced to shut your doors if you don't master the timing of that getting back into your bank account.
Yeah. Because I think, like I said, with some of the examples I've faced is like, but their growth, their required investment as they're growing is maybe a little bit less than the profits or the same, you know what I mean? So it looks good. And like you said, it's vanity because it's like, whoosh, look at all this money we're making. And then, but like you're also reinvesting in new staff, new things that you need now to service those clients that you did. And so the profits should be there, but they're also being eaten up with your desire to grow. Yeah. And then now that's like, so the cash flow is still there. The money's coming in and it's going out.
Yeah.
But not not what's left over is not the same as what's profit.
Right.
And so that's what you said, like, yeah, and then now the money is the cash left over is not there.
Yeah.
Yeah. Yeah.
Yep.
And that's the reality. Yeah. So what are like, I don't know, 3 to 5 things that a business can do to ensure that they're staying sane and that they have actual cash
They have
left
a good
over.
reality.
Yeah, they have a good reality.
Well, first off, I would just track what's going on.
Okay.
So every month I would be looking at an accrual basis financial.
Okay.
So that's a balance sheet, an income statement, and a statement of cash flows.
Okay.
So the balance sheet's going to show you assets and liabilities, and what you own and who you owe, and how much equity you have in the business, essentially. The income statement's that's like your report card. Was I profitable last month? And again, I would look at it on an accrual basis.
Mm-hmm.
When you're analyzing your company, I'd look at it on an accrual basis, based off what I earned, but like the work I actually did and the costs I incurred to do that work. Was I profitable? If you're not, that's going to have to be the first problem you solve. Eventually, an unprofitable company, you're going to have cash flow issues. Unless you keep running on outside money.
Yeah. Makes sense.
Which is the business model of some startups too.
Most tech startups.
Yeah, some
like,
industries, that's how they work.
Stupid amount of money before we make anything.
Right. And so that's part of the plan. But you need to know that going into it. Otherwise, it's going to be a real reality check if you don't realize that. And so look at that profit and loss, and then look at the statement of cash flows of like, what was my actual, hopefully, cash inflow from operations, right? Again, a lot of times what happens is they're profitable, but they actually bring in negative money from their operations because they didn't collect.
Yeah.
Or something like that.
That makes sense.
And so that statement of cash flows can kind of highlight what part of your business you're losing money in. Yeah. Is it from my operations? Well, that's a huge problem. I need to figure that out.
Yeah.
Is it from my investing activities because I'm buying equipment? That may not necessarily be a problem if that was part of the plan and I can afford that. Yeah. My operations support that. Maybe that's the thing. Yeah. Or is it my financing activities, the debt payments I'm making, those type of things. Again, may not necessarily be a problem, but just need to understand how it's working. So I'd look at that. I'd also create a 3-way forecast.
Okay, I'm excited.
So those same 3 reports.
Yeah.
Balance sheet, income statement, statement of cash flows. Forecast them out.
How long do you recommend forecasting out?
At least 12 months.
Okay.
To
keep like a rolling 12 months sort of thing going?
Yeah, at a very basic level, I would just do 12 months.
Okay.
Now, as you get more advanced, maybe you want to do a couple of years in advance, really get a good understanding of what you're planning for. Mm-hmm. But just as a starting point, I would get the next 12 months forecasted out of what that balance sheet's going to look like month over month as you buy equipment, make debt payments, improve your collections, whatever the case may be. See what that P&L is going to look like. How are you going to perform? This is where marketing comes in, right? Because you're going to need to talk to your marketing team, your sales team to understand, like, what are we hitting revenue-wise?
Yeah.
What are we targeting?
Yeah.
And then you can go and calculate, okay, well, if we hit those targets, and based off the margin we earn, based off the overhead we know we're going to incur, here's what our profitability will be month over month. Yeah. So that's where, the departments have to talk together and understand what's going on. And then maybe you run a couple scenarios off that. Mm-hmm. All right, what if we don't hit those targets? What if we exceed them? What does that look like? Taking into account commission structures and all of that, right? Take all of it into account.
Yeah, bonuses.
What's that going to look like? Yeah. Right. And then translate that into a statement of cash flows.
Wow. Mm-hmm.
So based off the profit I think I'm going to earn, based off how long it takes me to collect, based off the timing of when I pay those expenses I incurred, based off the investments in assets or the loan payments or all of that, what's going to be in my bank account at the end of each month?
Yeah.
once you have that in front of you, that's when you can actually, okay, I can't afford that equipment purchase. Or maybe I need to find a better way to do this, or improve my what happens if I improve my margin by 2%?
Yeah.
And my profitability goes up. And then how does that affect the bank account?
Yeah.
And what happens if I increase my prices by whatever amount?
Yeah.
You know, well, how does that affect the bank account?
Yeah.
And then get the whole picture, make your decisions of what you want to do.
Yeah.
You know, and then that's your strategic plan. And you go do it.
Yeah. It's one of the things that I love doing when I'm working with someone with their sales and marketing, and overseeing them, is working with the finance department to truly understand what their goals should be, and then creating a budget for us to then now work with, you know, to be able to hit those goals, and also have something to do that, you know, because on my side, it's like I see sales and marketing is always an investment, because you're paying to acquire new clients, you know, and then there's you know, you got to pay staff, you got to pay commissions, you got to pay for media, you got to pay all these things, and it's like on the back of my mind is always like, is the ROI for this what it needs to be, so that financially the company can continue to go where it wants to go based on like the overall goals of the company. And that can get, to me, that's fun, but it does require some discipline as a business owner. You can't be blind to how your operations functions and how it affects your profitability, your cash flow, how it affects how your budgets from finance affect your marketing and sales, which will affect operations, which will affect your finance in the future. They're all working together. And so that's.
And I'll say, I mean, you can't really do that forecast without a good marketing person. I mean, just to plug you, right? Of like, if they can't, the really starting point of like calculating that forecast on all three statements is, what do I think I can do revenue wise? And what do I need to invest in marketing and advertising or business development in order to get that revenue? That's like the first thing I need to know. Okay, client, what are you doing revenue? If they don't have a good marketing person who can tell them, it's just a guess.
It's just
I think I did this last year. Maybe I can increase it by 10%. Maybe they can. But I would feel a whole lot more comfortable before buying this huge piece of equipment if you knew that you could, or you at least had a professional guiding you in that. Because the more you can just feel confident in that number, even though, again, it's just an estimate, it's just a target, we can run a worst case scenario off of that, still look at even if worst case scenario happens, and we buy that equipment, what does our statement of cash flow says? And can we assume that risk? You know, is that risk at an acceptable level for us? And so the marketing sales department has to be involved in this in order for it to, you know, go well.
And that's funny because like literally, you know, without being this like a little pitch back and forth, but one of the first things I do with companies, right, when I start to work with them and they're like, well, we want to grow, and they think it's like, what kind of like clever ads are we going to run? And the very first thing is like, what are you tracking? And show me the mechanisms you're using to track that. Because in order for me to tell you where you're going, I need to know, like, historically what actually is happening with your sales team, what actually is happening with, if you're running ads or not running ads or whatever. And then, you know, if they don't have any historical data, like they just don't run ads, you know, it's been word of mouth or whatever, there's still some data there that is important for us to track. However, I can use, you know, based on my experience, you know, here's some thresholds that we can assume we're going to meet, even if your sales team is horrible, you know, or whatever. I want to talk to the finance person. Hey, show me where they're at. You know, if we do get in more clients, is that going to help them, or is that going to hurt them? You know, and so that's like, I think what's really important is just having departments talk to each other. You know, And that's why it is helpful sometimes to have someone overseeing a specific department that they're responsible for. You know,
Yeah.
like maybe the owner's like, no, I'm really good at the selling. I can handle the finance, and I have an accountant or whatever bookkeeper that helps keep everything track. But I can, I can guide maybe. Most of the time
Right.
they need someone after a certain point, but um, then make sure you dedicate someone that is responsible for your operations.
Yeah.
Being lean and
Yeah.
meeting all those things, all those criteria, so that you don't collapse.
Yeah.
Yeah, yeah. Very cool. I had one more question for you, and I totally blanked right now. But either way, it's always great talking to you, Hunter.
Yeah.
Super helpful. Oh, here's what it was. So investing in you in your business, right?
Sure.
Whether it's like talking to a moving company, they're like, how do I invest in trucks, commercial construction? Like, how do I invest? Equipment's it's really expensive in that industry. So it's like, do I invest? Do I rent the equipment, even though it's not a good deal, quote unquote? But it's a little bit like renting versus like buying a property, right? Do I just lease the office, or should I just buy the property since I plan on being here for a long time? Do you have ways of sort of calculating like, yep, buy, it's time to buy, or rent for the time being until we can see this? Do you have benchmarks or anything you do?
I mean, very simply, I would just go back to that three-way forecast of taking that, plugging in the different options. What does it look like if I buy? What does it look like if I rent? And seeing what comes of it. What does that do to my profitability? More importantly, what does that do to my reality? That statement of cash flows.
Yeah.
And just understanding what that does. That's really, at a very simple level, the best way to do it is just get an understanding of how does it affect that statement of cash flow. And then it's more of you got to also understanding what your goals are and what you're targeting and what you're trying to head towards, because maybe it doesn't have a huge way on the statement of cash flows either way, especially if you're taking out a loan to buy the equipment, right? Maybe the loan payment and what you pay in rent isn't really vastly different for your size business. Well, that's where you got to really understand, what are your goals personally? Are you okay with taking a loan? Do you want to do that? Is that, how does that affect what you are headed towards? And so that's another huge component of it. It's just understanding, because what's right for you might not be what I'm comfortable with, might be totally different from what the next person is.
Absolutely.
And so, I always try to be careful with benchmarks. You can use them as maybe like inspiration for what other people are achieving. Okay, they're achieving that. But, you don't want to just base your life and your direction off of what other people are achieving, because it might not be what you're setting out for.
Yeah, that's really good.
And so plug it into the three-way forecast, see the effects, what lines best with the direction you want to head, and go for it.
Yeah. So always look to the future and make sure that whatever you're doing, you're measuring to see how it affects your company in the future. I like it. Cool. Don't be reactionary.
I mean, to make a decision like that without plugging it in and really considering it, and considering the maintenance that you have to do on that equipment. Maybe the person you have to hire to operate the equipment. Maybe the extra revenue you can earn with that piece of equipment. To not sit down and actually crunch the numbers on all three of those statements of what that looks like. It's kind of like taking your family earnings and just like rolling the dice and saying, I hope it works out well. That's what it's like,
Don't do that.
Don't do that. Don't do that. Just spend the time, create the plan, get a good solid game plan. It'll save you time and money, and it will just give you the peace of mind too. That you've done your due diligence on it.
Very cool. Well, there you go, folks.
There you go.
All right. Well, Hunter, thanks a lot for stopping by. We got to do more of these videos.
Let's do it.
All right. See you.
See you. Thanks for having me.
All right. Bye, guys.